Last week, the focus turned to the US Federal Reserve and the Bank of England, as they both took to the stage to announce their latest policy updates, both keeping rates unchanged. In the press conference that followed the Fed's update, Jerome Powell pushed back against suggestions of a Q1 rate cut, but confirmed that it will be appropriate to begin loosening its monetary policy this year. There is a total of 140 bps worth of cuts priced in for the US Fed in 2024. For the UK, the MPC's vote was a three-way split, with 6 members voting for a hold, 2 for another hike and 1 for a rate cut. This reflects the Bank of England's assessment that inflation concerns are becoming more balanced, and the UK is on the right track to its inflation target of 2%. Bank of England Governor Bailey boldly stated in the press conference that they are not in a place to cut rates at this point. The market has 105 bps worth of cuts priced in, with June looking likely to be the starting point. Last week, we also saw a huge US non-farm payroll release, with the figure printing at 353K, versus an anticipated 185. The print demonstrates the strong employment growth in the US, and certainly pushes back the timeframe for rate cuts in the US. In terms of noteworthy market moves, pound sterling to euro is continuing to hold above the 1.17 handle, and is currently trading in a tight range. Meanwhile, pound sterling to US dollar took a hit following the US non-farm data release, taking a nosedive of over 1%. Finally, euro to US dollar also took a sizable hit following the US employment data, seeing the pair decline by 1%, dropping into the mid-1.07s for the first time since December. Ahead this week, the main highlights will be the Eurozone retail sales data, Germany's industrial production release, and finally, the US's non-manufacturing ISM release for January.